Hi, everyone. This is Ted Bauman here with Clint Lee. We are here talking about the state of the markets this week in Your Money Matters. Now, this week we are coming off quite a remarkable string of earnings reports from American companies, including some of the biggest companies in the country and some of the fastest rising companies in the country. But the focus on the big names may obscure what's going on in the background. And so I want to start our discussion today by asking you, Clint, what's the backstory? Where are earnings doing best in terms of different sectors of the economic palette here in the United States?
Yeah, sure. So great to be joined by everyone again. When we look at where we are so far with the fourth quarter earnings season, about half of the S&P 500 has come in to date. So that gives us a good sample size to start to deconstruct some trends and see where the growth is at. Interestingly, when you kind of look at all sectors combined, all underlying companies that have come in, utilities are actually leading the way with earnings growth. We've also seen some improving trends with financials. Financials have a pretty strong earnings growth so far this quarter, as does the healthcare sector. On the other side of that is energy. Now, energy companies can be impacted by the price of oil that's been particularly volatile. And so the energy contribution to earnings is dragging that overall growth rate lower. But more of on a blended basis, the S&P overall so far is just barely positive, up about 1.1% or so compared to the prior year on the quarter. Which is pretty similar to what we've seen the last couple quarters as well in terms of the growth rate.
So if I'm looking at the statistics, and I know that you and I are looking at the same ones, the one that really strikes me is the big drop in earnings in the energy sector. It has canceled out the good earnings in the sectors that you mentioned. So if you took energy out, the S&P earnings would have actually been a lot higher. Essentially, I think that's an important thing to consider because, energy is a bit of a special case in that it's not really up to the companies how their earnings turn out. It has to do with prices and things like that. So really, maybe it's a better looking earnings report than it would look if you just look at the top line for the S&P as a whole. Would you agree?
Yeah, I would. To your point, when you exclude what's going on within the energy sector, the profit picture starts to improve a little bit. And that's a trend we've seen the last couple quarters now, in that the quarter to quarter improvement has been slowly ticking up. The earnings picture right now, and actually a lot of this was energy induced as well, but it's similar to what we saw back in 2015 and early 2016. That was the last time we had an earnings recession. We had a couple quarters of earnings declines. We didn't have a GDP recession at the time, but earnings declines during that period were driven by energy sector as well. And so when you look past what was going on there, the underlying health and other sectors of the market were better than what the overall headline numbers would imply.
Yeah, and I think another thing to consider is that unlike last year, where earnings would have been affected by the tax cuts that were implemented at the beginning of the year, this year those have already happened. So to the extent that earnings are strong, we can take that as a factor out of the picture. So it's genuine earnings growth where it's happening. It's not just financial earnings growth because of accounting things like lower taxes. But I just want to look at a couple of statistics that strike me. I mean, one of the things, you mentioned utilities as having been a big growth sector in terms of earnings, but so far not too many utilities companies have reported. But in the consumer discretionary sector, I think what's amazing is that we've seen that 64% of the companies that have reported have beat estimates, which tells me that there's a pretty strong consumer demand element going on here as well. So even though consumer discretionary is fairly low in terms of overall earnings, the number of companies that are beating their earnings estimate is quite high. How would you interpret that?
I think you just pointed out there that it's been the strength of the consumer. That's a theme that we've seen in the economy for the better part of the past year now. And actually, probably going back to when the U.S.-China trade war originally started to develop. We know what that did to business confidence, to CEO confidence. We know what that did to the manufacturing sector. And so there's been sort of this pullback in business spending, yet we've seen the overall economic numbers continue to stay pretty strong throughout the year. I mean, it's not blockbuster growth, but it's not declining either. And really the hallmark of those stronger numbers has come from the better consumer, which is showing up in spaces like the consumer discretionary, as you mentioned.
Well, exactly. Now let's talk about a company, a consumer company, probably the most important consumer company in the United States today. It's Amazon. Had a tremendous beat and was really rewarded by the market. I think 9% jump this morning. How do we interpret that? I mean, it's this is a company that's been around for a while, and yet they still seem to be getting better and better at what they do. I mean, what were the big drivers for them this time?
Yeah, so I think with Amazon, it's always been this waiting game of when's Amazon going to finally monetize its market share, its dominance in online sales and e-commerce. I feel like that's been a theme. I could have been looking at this 10 years ago, and investors are paying attention to profitability in that space. Now, Amazon's profitability just over the last couple of years has improved very dramatically, but a lot of that's been driven by what's happened with Amazon Web Services. So that's in their cloud computing space. That's made up a bulk of their operating profits. Get back to this quarter, and in particular, some developments earlier in 2019, the company undertook this initiative to expand one-day delivery services. I think in the fourth quarter alone, they invested $1.5 billion to continue to deploy the service. But and while investors were a little skeptical, here we go again, they're making these big investments. It's going to further delay us being able to realize profits from that e-commerce segment. A couple things happened. One, the results were better than expected in terms of sales they were generating from e-commerce platforms. But then I think the other key number to consider is the Amazon Prime memberships. I think rolling out this one-day delivery has really resulted in a spike in Amazon Prime memberships. They have 150 million subscribers now. That's up 50% from the last time they publicly disclosed numbers back in mid-2018. And so this dramatic expansion of their user base, I mean, this is subscription revenue for them. This is more shoppers. And I think, investors are looking ahead to how that's going to start to impact this e-commerce segment as the investments in one-day delivery now start to abate a little bit.
So, you've mentioned a couple of different business lines that this company has, but I want to read you a quote that came from a New York Times article this morning about Amazon. It says, Amazon ads for Amazon products delivered in Amazon trucks to Amazon households, where Amazon cameras alert customers that their goodies have just arrived. So this is a company that has basically spread its tentacles all over the economy, on the consumer side of the economy. And, as you mentioned earlier, the cloud services has really been driving a lot of their revenue growth, which frees up money for them to use aggressively to pursue these other business strategies like one-day delivery. And I know I've seen it in my neighborhood. The trucks are everywhere. They're blocking the street half the time, but they are everywhere. They're doing this aggressively. So the other thing to consider is that besides the growth of actual retail through Amazon Prime membership, there's also the video side. I mean, the more Amazon Prime customers there are, the more people are going to be watching video on their platform, because there's the streaming wars thing going on as well. This company basically becomes, kind of the Sears and Roebuck of the 21st century information economy. It's everywhere. And I think that's really something that makes you stand up and take notice, that as old as the company is, as long as it's been around, it still comes up with these surprises, and it still wins every time it tries one of these new approaches to raise profits and revenue. But let me ask you about another company that has also surprised everybody, myself included, and that's Tesla. Tesla also had a tremendous jump in stock price over the last while. It's making some people feel like they missed the boat. Do you think that company is now finally arrived and is worth the valuation that it currently has?
Well, there are several signs that yes, they have arrived. And let's take a step back for a moment and talk about what arriving actually means. With Amazon, we just talked about how this, able to monetize this market share in e-commerce that they have for larger profits going into next year. That's, the company's being rewarded for that. The market overall, I mean, you look at what happened in 2019, a lot of the gains were just driven by valuation expansion. And so it's going to be important for earnings growth to finally start to come through. And I think that's what is happening now with Tesla. So there's a couple things with Tesla. They had the first profitable year in company history. They had the first time ever that back-to-back quarters showed a profit. But I think what was also key is in the company's press release, they made this commitment, they made a statement about becoming self-funding. And so what that means is that they're finally starting to generate enough profits, or they're not just accounting profits, they're finally starting to generate enough cash flows internally to fund their expansion. Because that's been a really big concern for investors up and down Wall Street, is how many times they've had to go, especially to the debt markets, to raise capital to fund their operations. But because of this improvement, this growth, this more consistent, and we'll see if it can continue, this is all eyes is going to be able to the consistency that they're able to deliver profits quarter in, quarter out. But that is what marks a key development in their transition.
Well, yes, and what's also amazing about that is that they did this in a year in which they constructed a new plant in China and are preparing to build a new plant in Germany, which are obviously expensive propositions, but they have been spending money this year, but they actually turned a profit, as you pointed out. And I think that really comes back to the question of unit economics. I mean, in manufacturing, it all comes down to how much profit you make for every unit that you manufacture and sell. Now, we know that the demand side for Tesla is great. I mean, there's a waiting list for their vehicles. So this really suggests that they're starting to get the manufacturing side of things right, that they can now make automobiles with a good margin for themselves. And for me, I think that the real question that it raises is, can they broaden beyond the current offerings that they have and start offering a variety of vehicles that will be of interest to all drivers, not just those who can afford, 30,000 plus price tags for an entry-level vehicle. Do you see any signs on that front? Are they talking about new products that might broaden their market?
Yeah, I mean, you've seen speculation and headlines being grabbed around the development of the truck that they're coming out with. But I think the more practical application, to your point, is going to be lowering that average price point. I mean, they have the factory in China now that you mentioned. I mean, people in China are not dropping $40,000, $50,000 on a new electric vehicle. That's something Tesla is going to have to come to grips with as they're rolling out new models at a lower price point to try to appeal to the demographic they're targeting, especially in China, because the opportunities in China, that's a leading electric vehicle market in the world. But you got to have the right product lineup to be able to tap into that market opportunity.
Yes, and I think that also raises an important thing to remember about Tesla, that in the United States, I mean, there is an implicit subsidy, well, actually a cash subsidy really, that goes towards the credit for buying an electrical vehicle. And that is a significant component of Tesla's business model and has been all along. I understand that China also has programs that reward people who move in the direction of an electric vehicle. So to a certain extent, this is a company that has been quite clever about leveraging public policy towards electric vehicles. Germany, another case in point. I mean, there are price supports and things for that. So that helps, but personally, I don't think that's the only reason that Tesla has managed to reach profitability. I think, again, I would go back and look at their operating costs and look at the divergence, how much more cheaply they can make a car now than they used to be able to. So that's everything for us this week, folks. Your money does matter. It matters to us, matters to you. We'll always be back on Mondays with our conversation. And this is Ted Bauman, Clint Lee signing off. If you haven't already, pop on over to my YouTube site and Twitter and Facebook and see what else is going on. And of course, if you're not already a subscriber to the Bauman Letter, please do. have a look at the opportunities there. There will be links in the emails that we send out showing how you can subscribe if you're not already. So Ted Bauman and Clint Lee signing off. We'll see you next week.